The gold price, this is at quarter end price, but if you were to do the intra-quarter prices, they almost hit $2,000. So again, you can say we have been in a bit of a range, sometimes a bit above it or a bit below it. And next chart shows even more so what has happened.
Hey guys, welcome back to Everyday Finance. In this video, Cathie would discuss about gold. Cathie Wood says, gold did surge, but it quickly fell back into a trading range. And now, after 2 tests, it seems to be resolving to the downside. All the inflation fears should have affected the gold price from the moment the currency crisis occurred. One of the reasons for that is that the dollar is strengthening, and this fall may be an indication of a liquidity shortage for the dollar overall. And she also discussed about copper. She says, we're taking this seriously because, like, electric vehicles need so much copper. We've broken the trading range that was established as electric vehicles were taking off this $4 to $45 range, and we're in a new range and resolving to the down. The wiring in electric vehicles is too well. The numbers are coming down. Used to be 5 times the amount of copper used in gas-powered vehicles. Now it's down to something more like 2 times, but still, you know, that's more intensive use of copper, and lots of things Cathie would discuss. So please watch the video to end, and share, subscribe our channel, Everyday Finance. Thanks.
And you can see the massive inflation in the 70s. Again, this is not a log chart. Maybe next time we'll do the log chart. You can see the accommodation thanks to Y2K and the Fed easing, which took us into and through the crisis. The gold price continued to move up, less because of monetary reasons, probably during 08-09, but more because of flight to safety, because of all of the counterparty risk caused by that financial crisis. And here again, if we were to look at this chart in the, we are looking at it in the context of history. The gold price, this is at quarter end price, but if you were to do the intra-quarter prices, they almost hit $2,000. So again, you can say we have been in a bit of a range, sometimes a bit above it or a bit below it. And next chart shows even more so what has happened. So all the fear about inflation should have impacted the gold price from the moment the COVID crisis happened. And gold did surge, but it came right back in. It has been in a trading range, and it does seem to be resolving now to the downside. We've had 2 tests here, and it's resolving to the downside. Part of the reason for that is the dollar is going up, and this decline could be a manifestation of a liquidity squeeze in the dollar out there. And then here's copper, Dr. Copper, the commodity with a PhD. What is that saying about inflation and interest rates? Well, you can see it corroborated that monetary accommodation of Y2K, and up she went. That's when the copper price surged to prices effectively where we are right now. So, you can say with a straight face, as measured by this metric of inflation, that inflation has, been in a band, in a fairly contained range for the last 10 to 15 years. There wasn't a new resurgence in inflation. So those expecting cost push inflation like we had in the 70s, that doesn't look like it's proving out. And here's the shorter term on copper. The reason we're taking this seriously is the amount of copper used in electric vehicles, the wiring in electric vehicles, is the numbers are coming down. Used to be 5 times the amount of copper used in gas-powered vehicles. Now it's down to something more like 2 times. But still, that's more intensive use of copper. And yet we've broken the trading range that was established as electric vehicles was taking off, this $4 to $45 range. And we're in a new range and resolving to the downside here too. On the next page, and this is the last page, but this is a little bit of a warning and a corroboration that we've been in rolling recessions, and Fed, please take note. So these are credit default swaps. Credit default swaps are insurance policies against the risk of bankruptcy. And we've got two metrics here. The purple is investment grade, and the green is high yield, so lower quality companies. And you can see what happened to both of them during COVID, quite dramatic. You can see what happened during the regional bank crisis in March, spring of this year, surged and pretty much have remained elevated. And on the high yield side, basically they're starting to gap out again, warning about something unpleasant out there. And I heard, or I saw that Mohamed El-Erian wrote, something's going to break here. He may be referencing this chart. The other thing to note is we never got back to normal, ever. Below 300 on the high yield and 60 on the investment grade. Did not get back down there. So the market is unsettled, and these are people who are watching balance sheets and trying and mega trends and just trying to figure out who's in harm's way. I think one of the things this is telling us is this bank crisis is not over. And if you look at the individual banks' credit default swaps, you'll see that some of the regional banks are gapping out now. And even the money center banks, which don't have as much exposure to commercial real estate, they are starting to flag a warning signal. This is also a set of disconnects as, the media pick up on the latest economic statistic. They're saying, oh, we're off to the races, or soft landing, or, whatever it is. And these charts are belying that and are just saying, be on guard here. And we are in terms of regional banks and others who are hurt by adjustable rate mortgages. And a lot of bank loans are adjustable. And you're going to have a lot of companies having to refinance or roll into a new interest rate associated with adjustable debt, and they are going to have problems. Private equity, they leave very little room, I would say, and we're looking to see some issues there. You've certainly seen it in the real estate sector. And I think probably what most people aren't talking enough about is corporate profits. Corporate profits sequentially have been declining for the last few quarters. Companies are losing their pricing power, and we're seeing real unit declines. And this is probably the biggest disconnect at all. I listen, and our analysts listen, to earnings calls by the dozens, some associated with companies we own in the innovation space, but I in particular tune into more cyclical companies just to see what's really going on out there. And we are not hearing a strong economy talk, and anyone associated with the consumer is really trying to call out the, in some cases, the distress that some consumers are feeling. So with that, I'll end it in a couple of ways. Innovation solves problems. Companies are going to lose pricing power. How do they salvage margins? Well, you look to cut costs or increase efficiency and productivity. AI breakthroughs are going to do just that. The productivity gains they're going to unlock are astonishing. Innovation gains traction during tough times. This is exactly when the market shares associated with our companies are going to increase, much like they did during COVID. Innovation solves problems was our mantra. Now, maybe our companies and stocks appreciated too much back then, but innovation does solve problems, and companies are going to be facing a whole new set of problems as they lose pricing power, and this rolling recession intensifies as this credit default swap chart suggests it might.